You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Mike and Moose? This is Mike from The Moose on the Loose. I hope you're doing well. I was talking with a DSR member the other day, and we were looking at the TSX 60 because he was looking at mutual funds for the retirement plan that he has. And he had a question about what's the difference between one fund or another. And of course, I don't give financial advice, but I wanted to show him why don't you just look at the performance, the allocations, the top 10 holdings. And one thing that struck me is, man, we are not diversified in Canada. So yesterday I was looking at the TSX 60, talking about the highest yield on the Moose. And today I wanted to share my favorite one, those that I have in my portfolio. And ironically, I was looking through the whole list, the 60 stocks, and I hold 13 companies out of there. Of course, some of them are in my Smith Manaver, so they are not full position. So full position, I do have 10 stocks out of the TSX 60. So what would you need to pay fees to invest in an ETF or a fund when you can actually just select maybe your top 5, top 10, and then have a pretty solid base for your portfolio? So I decided to give you my favorite 6 stock that are in my portfolio, of course, and why they are there. So position number 6, Canadian Natural Resources, CNQ. I may surprise a few because I'm not a big fan of the energy sector, but Canadian Natural Resources, it shows such a amazing dividend growth history. And the reason why, it's quite simple. Their business model is vertically integrated, and the quality of asset they own enables them to be profitable as long as the oil price is above roughly $35. So in a world where we're trading between $75 and $95 for a while now, well, they're racking up cash like there's no tomorrow. That enables them to buy back shares, to pay off debt, and to increase the dividend, all of those 3 things at the same time, which is quite impressive. Going forward, I don't expect CNQ to be a superpower company, though. I think it's going to be a little bit better than a Deluxe bond, but that's why I wanted in my portfolio. A nice yield, some good dividend increases, and if we're lucky, a little bit of price appreciation. But I don't expect this type of company to drive my portfolio, but rather to bring some stability. Speaking of stability, let's move on to number 5, Canadian Railway, CNR. This one, what is more stable than railroads, right? So you have the choice between CP and CNR. I opt for CNR because it increases its dividend every single year. That's mostly the reason why I decided to go with CNR instead of CP. Both are great railroad companies. I just love that mode where you cannot replace it. And another proof that it's true, well, both companies were into work conflicts with their unions, and the federal government kind of forced everybody to continue to work. Skip the lockouts, skip the strike, and get together to find an agreement. Well, that shows how crucial the railroad system is. It would have affected the entire economy. It would have even affected the Americans because all railroads are connected down south as well. So this is the type of business you want in your portfolio. It's going to be there in the next 10 years. It's going to be there in the next 100 years. Moving on to number 4. Number 4, Brookfield Corporation, ticker BN. I love this one. I love this one because it's an alternative asset manager. They have their toes dipped in plenty of different waters, and I like alternative assets. They are long-term play for like 30, 40, 50 years. And the main difference that why I prefer Brookfield Corporation, BN, to Brookfield Asset Management, that is BAM, is mostly because I like the fact that Brookfield Corporation will make profit when they sell assets. So BN is an asset heavy. They're using their capital on top of getting capital from other investors to invest in those alternative assets, while BAM is more about just earning fees on assets under management. So good stability for BAM, generating a higher yield. So those are great, but I prefer BN just because I want them to be involved in the projects. And when they sell at a profit, they will benefit from that also. If you're looking for more companies with strong dividend triangles such as CNQ, CNR, and BN, I invite you to download the Rockstar list on moosemarkets.com/rockstars. So it's moosemarkets.com/rockstars. That is a list I'm sending you every single month using the Dividend Stock Screener, where we pull out only the best companies with the strongest financial metrics. So they're not all buys, of course, but it's a great start to look for your next candidate in your portfolio. Now, moving on into the top three, and those were tough to determine. And I'm pretty sure that you guessed already which stocks are part of the top three, but maybe not this one. So Constellation Software, CSU, is my third favorite stock in the TSX 60. Of course, this one is not a dividend grower. It is an exception in my portfolio. It pays a ridiculously small dividend, but this is not why I want it. The reason why it doesn't increase its dividend is mostly because the management finds ways to generate more value for shareholders by reinvesting all their cash flow inside the business. They run a tight operation of growth by acquisition. They're making very small acquisition in the technology sector. They're vertically integrated, and their goal is to buy those small companies, get there with their expertise and their playbook, keep management in place, and make that business 10 times better. Well, maybe not 10 times, but a lot better. So they generate more growth with their expertise and playbook. They know exactly how to run those companies, and they usually get first dib on those small companies to be purchased because they benefit from a strong reputation, and also the fact that most venture capitalists will ignore those small deals because they're too small for them. So CSU is really just buying like a ton of companies every year. And if you look at their dividend triangle, the only problem that you will see is just the dividend remaining flat, because the revenue, the earnings, the cash flow, everything is going up on a very steady line. And that explains why the company has outperformed the TSX 60 and is doing so well for so many years. Moving on to number two. So now there's a battle between a convenience store and a bank, right? Well, might as well. I will tell you up front. Number two, National Bank. I love this bank, not because it was my previous employer, but because it is smaller than the others and it's more flexible. They go for growth, and they have made some bold moves in the past few years. And they have been right most of the time. So they generate more revenue and earnings growth, and they show the lowest dividend payout ratio among the big six. And of course, they are the most generous in terms of dividend growth. So the company shows amazing fundamentals. They have a lot of growth vectors, including capital markets, including wealth management. Now they're about to acquire Canadian Western Bank. I think it's going to be an amazing complement. They're going to bring a whole big book of commercial loans where they will be able to offer those clients additional products, including Private Banking 1859 for all of those business owners that are about to sell their business and cash up big checks. So anyways, I just love that acquisition, and I'm just looking forward to see what's going to happen next for National Bank. No more surprise anymore. Alimentation Couche-Tard, even my children are tired to hear me talk about this one. Kind of crazy, I know, but I just love this one. They're making a bet on buying 7-Eleven. Is it going to happen? Maybe yes, maybe no. They're really at the early stage. I've read so much stuff about this deal right now already, and people, I mean, like, come on, just take a deep breath. We're at the very early stage. I mean, chances are nothing's going to happen. So don't go crazy about this, but it just shows how Couche-Tard is going for growth by acquisition on top of finding other organic growth vectors by entering new products, updating their store, the way they are built, the products that they offer, having their own brands to improve margin is just an amazing business. And I just can't wait to see what's going to be the next move. Hopefully it's going to be 7-Eleven, but we'll have to wait and see. So that's my top 6: CNQ, CNR, BN, CSU, NATD. Of course, there are a lot of other great companies out there. I own some of them, some others I don't, and some kind of like a regret, especially like Intact Financial, Hydro One, Dollarama, Imperial Oil could be another one, Metro. So you see, there are plenty of great names out there, and I think it could be interesting to look at the TSX 60 as a starting point, but even better if you combine the TSX 60 and then you look at which one has a strong dividend triangle. Or you can save some time and directly go to moosemarkets.com/rockstars. So you're going to get exactly what you're looking for: strong and thriving businesses with solid fundamentals. All right, guys, that's enough for today. Tomorrow, we're talking about what is the best engineering firm in Canada. That's going to be interesting, right? So stay tuned and stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.